You guys do charge a management fee on your fund, which is a standard 2%, which is on a tiny fund of your size. It's somewhat unconventional because usually people don't do it. But what you do that is interesting with the management fee is that you recycle it and you actually deploy it in the portfolio. You don't take it on for you guys as the managers.
The core tenet is if you don't absolutely need the fees to live today, I think recycling that into the fund, aligning your incentives with the LPs, where like my success is my LP's success, I think it just speaks louder than any other pitch that you can put on a deck.
Rapha, welcome to the Slice Pod, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You are the co-founder and general partner of Darkmode, a $5 million fund investing 100K to 200K checks in early stage startup across the visa and infrastructure verticals. Let's begin where we always do, which is, was this always the plan? How did we get here? How did you get to start your own fund? Tell us about it.
First of all, thanks for having me. Super excited to chat. My initial plan was to be a soccer player. When I was younger, that was my dream. I grew up in the suburbs of Paris. And so every year we would play against PSG, like the big local team over there. And the older I got, the more we would lose by. When it starts to look like tennis scores, that's when you know that you're in the wrong business. But I kind of took all that life force that I was initially putting into sports elsewhere and moved to the US, actually to California. My family were expats in LA for 3 years. And that kind of completely opened up the aperture for me about what the universe sort of looks like. I only knew Paris and the surroundings where I grew up. Seeing the energy in California and then coming back 3 years later to my little suburb, the realization of like, there's such a big world out there. I got to go explore it. From there, like, I sort of ruminated for like a couple of years back in France. When I got to college, my obsession was like, I want to start a company. I want to go out there and sort of prove myself. With a classmate of mine at USC in LA, we started a company that pivoted probably 1 million times in the first like 12, 18 months. So one of the first AI meeting assistants back in 2017, 2018, recording and transcribing your conversations. And we were very vertically focused on recruiting, partially because we felt that the recruiting process was broken. And we felt like this concept of applying to a job with a resume, not being able to showcase your soft skills, why you were a good fit for a job. And we thought from the employer side, it probably drives a lot of bad decisions. And we looked at the stats and we saw that most hiring decisions end up being mishires. We thought, okay, like the data's there, let's go build this up. And at the time, Gong and other companies like that were blowing up for sales. And we thought, hey, look, like sales recruiting is very, very similar. This needs to exist for recruiting, but the workflows are different. So you got to build a separate tool for that. And so I ran that company for 6 years and ended up selling it to Gong. Throughout the process of building that company, was lucky enough to see other founders build alongside me. And over time, I thought, at the very beginning, I didn't have the capital to invest in them. So I would do like these super, super tiny checks, like $1,000, $2,000, just to be able to support. That turned into becoming a scout for one of the larger B2B funds in LA. I was investing in other AI SaaS companies back in like 2018, 2019 for that fund. That translated into dark mode in 2021, sort of by serendipity. Had one partner, Kat, who was in a very similar situation. Founder also was a scout for a fund called Sequoia. And then the rest is history.
But what was the aha moment that made you both go like, okay, like this scout thing, it's fun. We think we could do this on a bigger scale. Let's raise our own pool of capital and do this autonomously, essentially. Because like as a scout, you're still having to submit a memo, whether it's the upfront program or the Sequoia program. You're not exactly free to invest in whatever you believe in. What was it? Was there a pitch? Was there a memo that got rejected that made you go, we gotta do this?
In general, had a actually really good experience with the Scout program. I do think that over time, you realize that the focus area is very defined. And if you're someone who's very intellectually curious and you want to push the edge and learn the craft of venture and go outside of your comfort zone a little bit. Oftentimes you have to like break rules to be able to get the best kind of outlier outcomes. If you're just investing where everybody else is investing, there's not a lot of alpha. And in our case, the focus was very specific. There was a cap on the valuation, there was a cap on the check size. You obviously couldn't have conflicts, but those weren't investments that I had economic sense. The restrictions, you don't really realize them when you're doing your first 5, 6 investments, but you realize them after you make like a dozen or 2 dozen investments. Both Kat and I, and now we have a third partner, Amir, we felt that same impetus. There were people telling us like, hey, have you ever thought about doing a fund? Like, I'll literally give you my money to go deploy it for us. And then Kat, one day we were having breakfast and she brings up the idea to me and she's like, hey, have you ever thought of doing a fund? And to me, the idea was crazy because we were both doing our company. So it wasn't on my mind to start a fund on the side. And then we spent a weekend looking into the specifics. And we realized that by that time, the infrastructure for fund administration services, for example, had already become good enough with AngelList, Carta, and other companies like that, that a lot of the very back office work that's super critical to running a fund, but very annoying to do and not what we wanted to spend our time on, could be pretty much automated. And so that's what gave us a little bit more confidence to make the jump, basically.
Originally, you guys called it Evening Ventures. Was it like a play on like nights and weekends kind of thing?
Yeah, evening fund, you put your finger on it. We were literally doing it nights and weekends. And so we called it evening fund. And it was just an MVP, right? We said like 12 months deployment period. Let's see how this goes. Our second ever investment ended up becoming a unicorn. And so we were like, all right, the MVP is successful. So then when we brought on our third partner, Amir, for Fund 2, we were a little bit more intentional with the brand and we rebranded to darkmode.
I love it. And what was that first vehicle? What was it in size?
So first vehicle was 2.5 million and second vehicle is 5 million, which we're sort of halfway through now.
I'm sure that you, if you wanted to, you could have raised a little bit more than that. Why cap it at 5? What was the reasoning around the vehicle size relative to the check sizes that you cut? Because it's still like meaningful checks, like 100 to 200K. It's not like a micro angel fund. This is like a proper institutionalized pool of capital.
The first one was actually, we were targeting 1 million. So 2.5 was more than what we were planning to raise. We wanted to do first checks only, no reserves. Like if we wanted to do follow-ons, we would just, do SPVs with our LPs. The $2.5 million fund, first check only, essentially allowed us to do like 35 checks, 50 to 100K. Once we did that and were able to demonstrate access to great companies that went on, we essentially never had a J curve, which is maybe partially because it was 2021. Generally in funds, the first kind of 2-3 years, the performance goes down and then eventually goes back up. And folks call that the J curve. For us, because our second ever investment did so well and other investments got marked up very quickly too, it just sort of went right up. And so that made it much easier for us to raise Fund 2. And Fund 2 was essentially like an email to our existing LPs. Almost everybody doubled down. We brought on a couple of additional LPs over time, and that's it. We've never really spent that much time on fundraising because of the nature of the LPs that we sort of brought on.
Who are these people?
I think one group is operators and founders that are in our network. So folks that we've either worked with or we're close to. A lot of folks that are ex-Facebook, ex-Google, where my partners worked, or folks that we've maybe even invested in the past, etc. The second group is family offices or more sort of like institutional funds of funds. A lot of those funds, they're also interested in being able to position themselves into your winners to do the follow-ons, which is sort of a win-win because for them, there's alpha. And for us, it allows us to stretch our AUM without sitting on top of a lot of reserves. And then the third class of LPs is multi-stage VC funds or GPs at those VC firms. They're interested in the financial returns, of course, but it's also a way for us to collaborate on deal flow and to make it easier for our portfolio companies to raise their next round. So when they start to have a line of sight into when they're going to be able to raise their Series A or Series B, we're able to give them early access to a variety of top funds that we've vetted and that we work very closely with.
You guys do charge a management fee on your fund, which is a standard 2%, which is on a tiny fund of your size. It's somewhat unconventional because usually people don't do it. But what you do that is interesting with that management fee is that you recycle it and you actually deploy it in the portfolio. You don't take it on for you guys as the managers. If you're okay to share and talk a little bit about that, I think that's something that I really admire of your model because I see a lot of emerging fund managers getting into this thinking that they're going to get rich. and calling like 2-3% upfront on a 2-year deployment period on a $2.5 million fund, which I find quite silly sometimes. And when you told me you had a fee, I was like, I'm a little bit disappointed. But when you told me you recycle it, I was like, okay, this is interesting. What was the thinking there?
This is a really cool feature that AngelList enabled. Kudos to the AngelList team for thinking ahead there. I totally respect emerging funds that need to bring forward management fees. And so instead of having even that 2% flat structure, they say 3-4% the first few years and then it tapers off. If you need those fees, not just to live as a GP, but to pay for an office, pay for travel, etc. Especially if you're full time, it's you need to maybe even hire someone, right? So totally appreciate that need. In our case, we don't have an office, we don't have an assistant, we don't have a chief of staff. It's just the three of us. So we have very, very, very little fees outside of our fund admin. We don't care about getting paid a salary out of the fund today. Like, we're playing the long game, and we think the returns are going to be so much higher from recycling the capital and essentially having a higher stake in the fund. And there's other like secondary advantages, like tax advantages to sort of like recycling that capital and having it be like long-term capital gains. The core tenet is, if you don't absolutely need the fees to live today, I think recycling that into the fund, aligning your incentives with the LPs, where like my success is my LP's success, I think it just speaks louder than any other pitch that you can put on a deck.
I agree. We've seen like over the last few years, more and more of these like, big brand names try to go earlier and earlier. I guess that you try to get in sort of like first money. But I know that you've also done like some seed stuff. Like, does it ever get competitive with these folks? Do you ever find yourself in a situation where maybe you're passing it on to someone else rather than that guy and somebody gets upset? Or is it always a happy, collaborative, friendly relationship with everyone around the table?
My answer is probably very different than 95% plus of funds out there, because we very intentionally designed, you've probably heard this a million times, your fund size is your fund strategy, right? I think there's a lot of truth to that. In our case, we are very intentionally designed as a much smaller fund. For context, I'm a full-time operator at Gong. I sold my company to Gong and now lead new products at Gong. My partner, Kat, is CEO of her company, Veretto, which is venture backed. When you're full-time operating, part-time investing, you have to be realistic about what is the right check size and be very self-aware of what stages of maturity in a company and which verticals can you add asymmetric value versus other investors. And for us, it's pre-seed and seed, B2B SaaS, dev tools, and infra companies. That's where we're really good. And so in that realm, if you just write a 100 or 200K check in anywhere between 1 million and let's call it like $6-7 million seed round on the very, very high end, you're not leading, right? So the leads to us are pure collaboration. Oftentimes they'll even bring us in because they think we can add some operational value that sometimes even their own platform teams can bring. But even with the smaller funds, like, that's where you can rub elbows a little bit more. If there's a very, very small allocation for like co-investors, that's where you can have that competition. But I think, generally, if you did the work, if you have a great relationship with the founder, there's no reason that with our model, a 100 or 200K check is too difficult to accommodate. But if we were deploying K checks, $1 million checks, and anything above that, it gets more and more and more competitive. So then it's not just a game of access. The product you're selling is much harder to sell effectively.
So what would you say the product is? Because clearly it's not the 100K that makes the difference to the founder's life in that point in time, right? It's not going to make or break their fundraise. What's the pitch that you give to the founders? What is the value add that you sell to the GPs that bring you the founders? What is the reason why they want to bring you into these deals?
I think bringing on 3 founders who have either sold their companies or gone to the growth stage when it comes to CAT and are still building today de-risks the path to product market fit, raising your next round, and positioning yourself to scale beyond that. We're very realistic with the fact that from pre-seed to Series A, maybe Series B, this is where you're going to get 80, 90% of the value from us. And then beyond that, you're going to bring a different class of investors that help you go from Series A, Series B to IPO. You mentioned, for example, tier one multi-stage kind of funds going earlier and earlier. I think there's almost like an inverse correlation to value there for a lot of those checks, because for the most part, you are such a tiny fraction of their fund. Like either one, they're not even joining your board. So you're just a bet for them. And if you crush it, fantastic. If you don't crush it, it's actually negative signaling for the next round, because they're only going to do a token check or no check at all. So that's a big problem. And the token check, there's even a word for it in VC land. It's funeral costs, which is, I think, such an atrocious word, but it's a real thing that those funds model. They know that them not doubling down is negative signal. And so they have this concept, which I think like sort of highlights how to think about the value of those checks. It's not to say that they don't have value, but it's a very different type of value than what we provide, which is much more operational and tactical. Like we'll literally recommend talent to you. We'll help you find customers. We'll help you structure your fundraise, structure your hiring process. Like those are things that, depending on where you need help, we've usually had to solve those problems before or recently.
And how do the founders hear about it? This is a nice song. I'm a founder. I just like, it's like Ulysses, like, just kind of like getting attracted to the sirens. Is it just word of mouth? Is it a mix of these GPs bringing them to you? Do you go out, spend time pounding the pavement of the streets of Silicon Valley? What's the source of this glorious deal flow that you have access to?
Honestly, there's no rule. It's like a go-to-market strategy. You have to try a bunch of different channels, see what works for you. My partner Amir, for example, he has a big following on social media, on Twitter, LinkedIn, etc. He writes a lot of content, so he gets a lot of really high-quality inbound. But what's even more interesting than the direct high-quality inbound is it keeps him top of mind for folks in our network, whether it's emerging funds or GPs of top funds, especially in his vertical, which is developer tools, developer platforms. He has really ridiculous access to deals that oftentimes feel like they're way above our weight class, because one, that super high quality content, and two, of course, track record as an operator. And I think three is the word of mouth. And you can go on our website, you can see the founder quotes. If you just talk to any of those top founders that we've backed, like they'll tell you what it's like to work with us. And so I'll tell you, like my favorite source of deal flow is an existing portfolio founder introducing us to another company. Because to me, there is no better source of deal flow than that. I would, 10 times out of 10, take that introduction and invest in a company like that rather than another VC introducing me to a deal.
And once you find the one, there is three of you. Do you have like swim lanes, sir? Do you make decisions together? It's a pretty small fund. These are pretty small checks, but like you're partners in this together. What's the process on your end, and how do you manage it?
We don't make decisions by consensus. So we don't think that consensus drives optimal decision making, nor does it drive the velocity you need to make the right decisions at the right tempo to win the best deals. But another core tenet, which almost feels contradictory to the first one, is we do believe that each other's different point of view and different set of experiences, pushing back on each other allows us to make better decisions, right? So there's a reason why you get sort of three founders for the price of one, and we do the fund together as opposed to just independently each making our investments. We actually get a lot of value from sitting down at our partner meetings. We have our own sort of internal template format that we have aligned are important to answer for any deal that we look at. And we sort of push back on each other. Because we have all very limited time that we allocate to venture investing, we're pretty ruthless with how we spend our time and then how do we progress deals throughout the funnel. And so we actually have stages for this internally, literally as if it was like a CRM, right? From awareness, like I'm aware of this deal, to I am considering this deal, at which point I'm doing research, but I haven't socialized it with my partners unless one of my partners' expertise spikes in that area, in which case, they're leading the evaluation. And then to go from considering to strongly considering, which is like our last step before investing, that's when we start to develop a memo and start to answer these much more structured questions. and drive that discussion. The process is pretty simple. It's like, let's say that you were a portfolio or like a prospective portfolio founder. You would meet me. And then if I really like you, I really like the company, we have a good vibe. To go to strongly considering, you would meet only one of my other partners. And then as long as two out of the three of us are a thumbs up, that's how we move forward. And we try to keep a really high bar for those thumbs up because we only do a handful of deals per partner per year.
What if the partner does not align? Do you get the third leg of the stool to weigh in and be a tiebreaker, or if there is a doubt, there is no doubt, and you just kill it?
If the doubt is about the market, then I think it's just a question of doing more research and aligning on what are we excited about and what do we think are the risks about a market. Like, for example, I don't like this market. I don't like a company that sells into this vertical that just seems too small today, right? And so it's totally normal that if you've done the work and another partner hasn't, there is a information that you need to close in order to drive that alignment. And that's where the memo can be really helpful. I think the much more fundamental misalignments that generally end in a no is lack of conviction in the founder. And in fact, in order to make that less subjective of like, I like this person, I don't like this person, we developed almost like an interviewing scorecard internally with the key competencies of founders. Because the reality is building $1 billion or $10 billion company is absolute insanity. The immense majority of people probably don't have what it takes today to go and do that.
And you know I'm gonna ask you, what are the core competency of a billion-dollar founder? Like we have to know.
I mean, I think like one is they're able to articulate how present trends will create this future picture with a level of clarity that it almost puts you off guard by like, this almost seems so obvious. I think that's one inclination. The other is really around execution. We look a lot at the slope versus the y-intercept, meaning velocity of execution, asking a lot of questions about how the founder makes decisions. In the recruiting world, you have this concept of the who method, right? Which is like, describe what you did and explain why you did that. And then that's going to help me glean insights into how you make decisions. That's one of the key things that you can do when you're talking to a founder. And so just asking them questions about their background, college, jobs. Why did you take this job? Why did you leave this company? Why are you starting this company? What does success look like? And then lastly, the other one that I'll mention is go meet the co-founders. I think oftentimes the CEO will drive the fundraise. And so you just talk to the CEO and the CEO can be very charismatic and you can have a great match, but go meet the CTO, go meet the other co-founders, look at the dynamics between the co-founders.
Well, I'm sure you developed a good pattern matching algorithm over the last, 50 plus deals that you've done. What's one thing that, going back to the very first check that you cut and the latest one, what was the biggest lesson that you can glean looking backwards? Which doesn't mean that the first check was a bad one. It could have been like your best performing one. It doesn't matter. But what is the one thing in that pattern matching algorithm that you've realized over time?
Yeah, that's a great question. I think there's the first check I cut as an angel / scout, and then there's the first check we cut as a fund. And I think the answer is probably different there. But I think when I first started investing in 2017, 2018, for the most part, I felt like my edge and my focus was to invest in founders that looked a little bit like me, meaning they were young, really hungry, didn't necessarily have the pedigree, didn't even necessarily come from a great school or had done the internship at Google or the whatever, but just seemed to have this just like outlier grit to just like win. And I think the first check that I wrote, it's a company called Marigold that's still doing great. They just raised a growth round. It was, very young co-founders, but you could tell that they were going to go on to do great things. And it was either going to be this company or the next one. A lot of my first checks were that persona of founder, of course, with micro differences, but that's the macro persona. Another persona that we've unlocked over time is repeat founders, oftentimes who had a decent outcome or even a good outcome with their first company, learned a ton, made every mistake in the book. Oftentimes, it could be even the same team getting back together. I think from us building our own companies and realizing that no matter how exceptional you are, getting it right the first time is like almost like pulling off multiple miracles stacked on top of each other. The likelihood, it feels like, of those outliers second time founders just seems so much higher.
You've mentioned that for these folks, you wanted to be the super angel that you wish you had when you started your companies. Now the portfolio is growing, and I'm sure, and you have a full-time job, and you have two partners, and you have new investments to make, and there will be new vintages and whatnot. How do you manage to keep on top of all the founders, of all of their challenges, all of their problems, as things scale?
That's one of the things I spend the most time thinking about. Like I don't think it ever stops. I think it's you always have to become more and more efficient because to your point, the pressure always becomes higher and higher. And even in your personal life, right? There is never a shortage of distractions and competing priorities. To me, it's always focusing on what are the top most important things. And not all of our portfolio companies need the same level of help at all times. When you zoom out a little bit, the fund one portfolio companies, let's call it 2, 3 first years of that company, is where we position ourselves and we set the expectation that this is where we're going to help the most. So you get operational, help position the company for product market fit and scale, introduce them to investors, help them raise the next round, so on and so forth. At that point, my incremental value goes down over time, which is great because then the founder needs less help from me. They're moving on. And then in our case, that leaves room for the next sort of almost batch of portfolio companies to come in and sort of fill that gap. The other piece is having really good like systems and tooling. Like if you automate as much as possible of the non-strategic administrative stuff like fund admin, alerts, it just helps you be more productive. So that's the other side of the story.
We were chatting with Hugo the other day. He has like automation workflows between Airtable and text.com and whatever and whatnot, like lots of fancy little things. What's your stack? Like, how do you operate the fund?
Yeah. So my stack is a lot more dumb. I'll probably need to shoot him a text and steal his stack. That's a good reminder. Our stack is very simple. We use AngelList for our back office, which is fantastic. We used another fund admin for fund one, and we realized that it was a lot more manual work than we wanted. So you still had to manage the lawyers, you still had to manage the tax firm sort of all separately. With Fund 2, with AngelList, we found that you could actually do it all in one place. And so they really do take care of like side letters, signing docs. They handle all your taxes. So literally for me, it's like a K1 pops up at the end of the year. LP management, doing capital calls, gathering the wire information, even just doing investments, right? Like you want to do an investment, you can just loop in the fund admin and the fund admin essentially takes care of the entire closing. So things like that, they really add up and allow us to really focus on investing and helping our companies. Just outside of the stack for a second is because we're not myopically focused on growing AUM as a fund, right? We're very content with much smaller kind of sub 20 million fund sizes. Like that's our strategy. We don't spend a lot of time on fundraising. And I think most GPs, you would be surprised, spend up to 50%, sometimes more at different times on fundraising. And that's completely at odds with adding value for portfolio companies or sourcing great deals. And then as far as like our kind of how do we keep track of deals, how do we do the little automations with Alert? Very simple. It's all built in Notion, and Notion keeps shipping more and more great functionality to make it easier for us. So we're just like, rising with the Notion tide.
God bless Simon. Thank you for gifting us the database of our dreams. How do you keep all your ducks in a row personally? You have a full-time job, you have two other partners, you have the existing portfolio, you have new investments to make, you have LPs that I'm sure, like, you're not chatting with them every day, but like, perhaps it's nice to let them know how things are going every now and then. How do you juggle all of this?
Ruthless prioritization and time blocks. I have my day job, which keeps me pretty busy. I'm reactive over email, not 24/7, but like as long as I'm awake, I'll be pretty reactive to email or WhatsApp. So I'm always sort of like fairly easy to reach and reply and unblock other people. So I think that's also also a factor. My wife doesn't always love it, but it's sort of a fact of life when you're juggling the different priorities. And then I think it's time blocks. Like what I find is the most the biggest impediment to my efficiency is the context switching. And then again, being very ruthless with like how many meetings do I take a week and finding that split between new opportunities versus existing portfolio and making sure you keep that balanced. And then as far as LPs, like our LPs are fairly hands off for the most part. We as GPs are the biggest LPs in our own fund, which also makes it easier because it's pretty easy for me to keep touch with myself and with my partners. So that part is easier. And then with our broader group of LPs, we have quarterly updates, and every roughly trimester we do sort of like an LP social, either virtual, and then I think now we're trying to do more stuff in person as well.
Love it. If you could go back in time to when you started scouting or to when you started your football career even, and you were to tell your younger self, like, okay, like, these are the things that you have to prepare for. What are the surprises, both positive and negative, that you've encountered doing this that you wish you knew before you started?
I come from a family where both my parents worked for the same company almost their entire lives. Big kind of French companies that where the progression is very linear, everything is very structured, very sort of rules based. And so I think maybe by osmosis, I assumed that the world was a meritocracy and you just work hard and like things linearly sort of happen. And I never really considered the risk dimension until I started a company basically out of college and then did the fund, right? And so I sort of always did things backwards, right? Like starting a company before ever really having a real job, starting a fund before ever really working full time in a VC fund. I don't know if they would pay off for everybody, but for me, I feel like they paid off because I thrive on being thrown into the deep end and then forcing myself to figure it out. I realized it by luck quite early, like around college time, because I had this co-founder who inspired me to go start a company. And I don't think I would have done it fully if it wasn't for his push and charisma that brought me into the idea. What I would tell my earlier self is realize the importance of risk and try to take more risk if you can, if your situation allows for it. Most people try to do the opposite. They try to do risk mitigation. The typical, like, you do consulting, you do banking, you do the next job, and you're sort of always trying to keep your options open. And I think the opposite, there's a lot of value in trying to go deep and taking a risk.
As you were talking about the risk piece, right? It's kind of funny because I feel like most institutional VCs are sort of like the opposite of that risk-taking piece. Like, sure, they're paid to technically take risk, but like, they're always looking at the downside. They're always looking at minimizing losses because they don't want to have the difficult conversation with their LPs that is like, why did you invest in this guy? So like, of this new generation of folks that were like, it's smaller portfolios, smaller checks, it's lower stakes, who are the other Raphas of this world that are doing a hell of a good job, in your opinion? I know they're not competitive to you, like nobody would be, but they're competitors in this discipline, and you guys are like sports people, and you just excel together.
I think there's different models I admire that we look up to a lot at darkmode, and we're lucky to also work with those funds for the most part. I would say like Pietro's fund, who was on your podcast, I'm a big fan of Pietro. I think like pre-seed investing in Europe that is founder friendly with a solo GP who will hustle for you is such a gap in Europe. My experience with European VCs was so different than that. I wish I would have encountered someone like Pietro when I was first raising for my company as like a French founder and my co-founder being Italian. So I think that's one big one where I think he's solving a gap in the market and he's perfect for it. A couple of others that come to mind, Ian Finney from TCP, the Canon project. So Ian basically is one of the best people in the world at recruiting like founding go-to-market hires. And so he has the recruiting arm of his business, but then he launched a venture fund to invest in some of the best companies that he works with, and vice versa. And he is, in my opinion, so much better at that than almost any platform team that you can find out there that'll give you a head of recruiting to kind of help. And so I think, and since it's so critical to the success of a company, I think what he's doing is really, really awesome. And then I would say last one is a GTM fund. Big fan of what they're doing at GTM fund. Know a bunch of their LPs, and they've put together 200 plus GTM operators. Like CMOs, CROs. It says heads of customer success at some of the best SaaS companies. So those are three like very very different models. I think they stand out, and I think there's alpha in that versus your traditional fund.
I 100% agree. What's the best way to get in touch with you? Let's say I'm a founder or I'm a potential LP. Do you even approve of like people shooting you a cold email or a cold DM on LinkedIn?
Absolutely. Yeah. Love cold inbound. We've made investments there. I love like thoughtful cold messages. Like why us? Is there anything that we said that resonates? Portfolio companies that resonated. So I always urge founders like think of the why, because there's so many funds out there, right? If all you need is a 100K check, there's so many places that you can go to. We spend a lot of time beyond the 100K check, and so I think that's why for us it's also important to see what is the fit there. If you're doing like a direct to consumer company that's completely out of our scope, that's also where I think you have to be thoughtful. But yeah, we love cold inbound. No problem there. Best way to reach me, Rapha at darkmode.vc over email, or shoot me a message on LinkedIn.
Rafa, thank you so much for sharing your, is it still morning over there? I guess mid-afternoon.
Till morning.
Like,
Yeah. Yeah.
yeah, with us, your Friday. Really appreciate your time and listening to your story. I think if this was an LP pitch, you would get the check. There is a couple of things that I really appreciate from what you're saying. And like, as you know, we talk to a lot of people that do what you do. Um, but mainly in your specific case, you can tell that you're a product guy and you can tell that you're a very structured thinker when it comes to assembling the machine that builds the machine. And to me, like, when you're doing this like early stage, volume game, it's really very much about having a well organized process and trying to get as many shots on goals as possible. That comes when, repetition and discipline and being able to like, articulate your vision is one thing, but like, bringing it to life is a whole other. It's super cool how you went from like the suburbs of Paris to selling a startup to a multi-billion-dollar company, and then eventually like reinventing yourself as an emerging manager. I cannot wait to see what happens next and how many more of these funds you're gonna raise. And I think you're quite genuine when you say that you're not in it to like, play the AUM game and that you're just gonna keep it small and consistent, because ultimately probably what you enjoy doing the most is just working with people like you. I can tell you it's lost as you scale for sure. It becomes a very different kind of game. And you start spending more time with your actual customers, who are the LPs, who are the ones that are actually paying the bills, and less time with your product, which is your portfolio, which is what makes you valuable.